Okay. So, good morning, ladies and gentlemen. As Valuation Manthan series has come up with another knowledgeable and information session for us. Valuation Manthan series aims to deepen our understanding of valuation methodologies, exchange ideas, and foster growth in this critical domain. So, myself, CA Nisha Sharma, and I am your moderator for today's session. I would like to welcome our chairman, CA Hansa Chutsa, and our distinguished guest speaker, CA Sachin Chutsa. And we are truly privileged to have CA Hansa Chutsa leading us and provide us with an opportunity to make our Sundays productive. And as you all know, that it become a ritual for our Manthan series that we can't get started without a kind words from our esteemed Chairman C.A. Hansa Chutta. So I would like to make a request to Sir that Sir kindly say some few words before we start with the session. Over
Yeah,
to you, Sir.
thank you, Nisha. You see, like any journey or anything which really has to brought out for the membership, which gives the strength of the knowledge, and that goes on a continuous basis. That has the many advantages position. With that thought process, only this valuation manthan, which is going today, the 14th series will be aired live by our learned speaker Sachin Chug, who happens to be a chartered accountant, in addition many other qualification, and a word over traveled person who will be bringing out so many good things under the regulatory mechanism under FEMA. Whatsoever we needs to have a valuation system to be taken care of, in addition to the valuation standard whatsoever is being brought in by the Institute of Chartered Accountant of India through this valuation standard board. And you see, like if we divide the valuation system into two set of principles, one which requires under the regulatory requirements under the different law, different regulations, and another for the business or the commercial purpose. So the it goes definitely on the basis of some principles and some kind of the standardization. And today, with the better understanding, for the better understanding of the subjects which requires under the regulation, under the FEMA, under an act, which really gives us the transaction to be understood, which is being covered under the FEMA. So with those concepts, this today's program will be there. We are fortunate enough this valuation standard board has a support from the many corners internally. We have a team which has been secretariat, which has been looked after by Sonali Haldar, and as well supported by the Dimple and Rahul also as an officer there with the as a chartered accountant there with the board. And we have a well supported by co-chairperson with me, Preeti Savla. She hails from Mumbai. She may be joining at any moment to guide and to the participants and take care of the this board also. You see, like valuation has emerging like anything as the transactions are increasing, as the merger and acquisitions or the manifold, the startups or the we talk about the IPOs, and the economic environment is dynamic. In that sense, the opportunities for the members are huge in this valuation front, and we are hopefully, we are quite hopefully as far as our RVO also well supporting to the membership, our registered valuer organization, which is one amongst the largest valuation organization in India. And we have a collaboration with the not limiting to our Indian organization, but we are a collaboration with the overseas or the international bodies also. So our board is well equipped to serve to the membership. And I'll request the membership also at the same time, because we are expanding horizontally and vertically, not limiting to our financial assets, but in the time to come, we'll be moving towards the other assets also, whether it is the plant and machinery, whether it is the land and building, or wherever, whatsoever is required in the whole ecosystem of the valuation. I'll request each and every participants which are running into thousands, and it is this program more particularly. I'm talking about the valuation manthan today, fourth series. Starting from the first one, we see the growth happening with the participants number increasing with and getting into the best of the knowledge. Though Sunday, normally we talk about it, it is an easy day, but the Sunday starting 10 a.m., we thought of let us also have a some kind of the the knowledge or the strengthening the knowledge on the Sunday day, Sunday also. So with those concepts, this series has been started with and definitely bringing best in the system. Today, Sachin ji will be taking care of under the valuation under the FEMA, and hopefully at the end of the session, we'll be finding ourselves more knowledgeable, more clarity in the our understanding of the subjects related with. And each and every participant is also requested wherever you feel like you want to associate with the board in the different groups or somewhere in the system for the we have started a quarterly newsletter also in the evaluation standard board. If you can suggest something or you can write something for this our newsletter also, that will be a great support to this board. And hopefully with the support of each one of you, this board is growing with leaps and bounds, and it will be giving a different direction to serve to this profession. With this initial remarks, I once again welcome each and every participants. I welcome our Sachin Chokji, the speaker of the day. I welcome our moderator, Nisha ji, my officers there, tech team also. I welcome each one of you for this great time to come. Great program, great show. Over to you, Nisha.
Thank you so much, sir, for such motivational words also. As I have already mentioned that sir has taken such an initiative that make our Sundays productive. Otherwise, Sundays are lazy days. So, as sir has already mentioned that our vice chairperson, CA Priti Paras Savla, may be joining in any moment during the session. So, before we kickstart today's session, I would like to welcome our distinguished guest speaker, Mr. Sachin Chugta. And I would like to say a few words in his introduction. Mr. Sachin Chogji is a highly qualified professional with a diverse range of expertise and experience in the field of finance and consultancy. He is a DISA qualified professional, which demonstrates his proficiency in conducting information systems audit. He is also a certified valuer from the Institute of Chartered Accountants of India, indicating his specialization in valuation services. So, Mr. Chuk possesses over 10 years of experience in various areas, including audit and assurance, business process outsourcing, corporate consultancy, and business restructuring, FEMA, advisory, etc. So, his extensive experience signifies his in depth knowledge and understanding of financial processes, regulatory compliance, and strategic business restructuring. Overall, Mr. Sachin Chug's combination of qualification, expertise, and experience make him a valuable professional in the fields of finance, audit, corporate consultancy, and FEMA advice. So, Sachin sir, welcome to Valuation Manthan series, and I hope that all the participants will have enlightening session, and we will uh, have the opportunity to have thorough knowledge from today's session. Over to you, sir.
Thanks, Nisha. So I'd like to start by thanking CA Hansraj for giving me the opportunity to share my thoughts and some experience that I've gathered over the years in FEMA and valuations. And thanks to our Pro Vice Chairman, who I'm sure will be joining during the course of the session. And overall, thanks to the Institute for creating this platform for people like us to come and share our thoughts and multiple others to kind of exchange ideas. So valuation is a very, very creative subject. There is no set pattern, set rule. It's an art, it's in science, it's everything put together. So sometimes, I feel that valuation is like a, very, very solid Bollywood movie where you have dramas, twists, and unexpected turns. But we aim to, the difference between a Bollywood and a valuation story is that we aim to arrive at a fair and accurate number. and not just ready, dance with numbers. So it's very complex, but let's hope. It's pretty complex, but I'm going to try and make it simpler for you. So with your permission, Hansraji, I'd like to share my screen and start off today's session. Is my screen visible? Okay, cool. Thank you. So why would a valuation, let me just put a small, joke in front of you. Why would a valuations professional carry a ladder to a valuation activity or assignment? It's because they always want to reach higher in valuation numbers. So per se, everybody has been thinking of valuations being a high number, but I think it's time, it's ripe enough, it's matured enough that a valuation may be thought of as a fair number now. So Oscar Wilde once said that people these days know the price of everything, but the value of nothing. And how do you think we should arrive at a value of something? And more importantly, who is that person who should arrive at that right and fair value? I think as chartered accountants, we possess the necessary skills. It's in our blood. The financial expertise, the knowledge around numbers, regulatory compliances. And with our independence and objectivity, we have over the years built trust and credibility to bring to the world a report, a number which people can rely on. Because we try and always talk about true and fair. I think since our articleship days, the first thing that's taught to a chartered accountant to be true and fair. And a valuation professional and a valuation activity should also try and talk about a fair value assessment. Now, in today's session, we're going to talk about various valuation requirements under FEMA, Foreign Exchange Management Act. So FEMA, so we all know that all foreign exchange transactions in India are regulated under FEMA. They're not controlled anymore, they are regulated. That's the lateral shift that we saw when the country moved from a FERA regime to a FEMA regime. FEMA brings in a lot of positive changes into the foreign exchange transactions. They are now administered and regulated through Reserve Bank of India. And Reserve Bank of India is very ably supported by a plethora of authorized dealers, essentially generally large banks and some other as well. Under FEMA, every foreign exchange transaction, whether it is inbound or outbound, by inbound, I mean money coming into the country in foreign exchange, convertible foreign exchange. And by outbound, I mean money going out of the country in convertible foreign exchange, is monitored, is regulated, is controlled. FEMA has brought in various automatic approvals within its system, within its rules and regulations, under which a person just need to do a transaction reporting in the required format rather than go seek an approval for everything. It's no longer that regime where without the permissions, I could not do anything. It's come to a situation where within the guidelines and regulations and rules and the master directions shared by the Reserve Bank of India, which regulates the FEMA environment, I'm able to automatically conduct a lot of transactions. And obviously, they are very well checked, and checks and balances are there in place with the authorized dealers who are the carriers of these transactions, the bank accounts, the banking companies. Under FEMA, when we talk about capital account transactions, we are talking about inward capital account transaction. That means money coming into the country. That means foreign direct investment, which means debt instruments as well. By outbound transactions, we try and look at overseas investments and overseas direct investments. Apart from that, there are multiple current account transactions, which are regular trade payments. So people importing goods, importing services, Indians exporting goods and exporting services, individuals, sending out money for their travel needs, education needs, family support needs, gifts and all that. All of those transactions are all covered under this FEMA environment. But in today's session, we'll try and focus on, as CA Hansraj said, valuations under FEMA in case of financial assets, essentially, because that's where we are we are kind of focusing on in today's seminar, and that's where us chartered accountants are required to conduct valuations when we talk about these. Under FEMA, what generally happens is that the transactions between two parties have to be considered. And what kind of parties are we talking about here? So I'm talking about this because I'm trying to set a context to the entire conversation that we're going to have, in the next 1 hour or so. I'll try and keep it, short and swift and crisp so that you don't get bored and try and make your Sundays worthwhile. But the three kind of transactions that we are talking about here is a transaction between a resident Indian. So people like you and me, who live in India, practice in India, work in India, have businesses in India, and a transaction between a resident Indian with a person non-resident in India. It could be anyone. It could be a non-resident Indian. It could be an OCI. It could be a foreign national. It could be a company. It could be an entity which is non-resident in India. The other way around also is a kind of a transaction which is to be assessed separately, which is a person non-resident in India transacting with the resident Indian. It's a different story altogether. We'll learn about this when we go down further. It also, FEMA doesn't directly address a transaction between two non-residents, but it certainly talks about how we should look at, because overall it's all about Indian assets and foreign currency being transacted somewhere else or the other. That is where FEMA actually comes in. Now, FEMA and valuations have had a long history. But today, what we're going to try and do is segregate the transaction that we are going to talk about today and focus our energies and effort into understanding how these valuations are conducted, what are the rules behind it, only of specific kind of instruments. So as I said, if I break the kind of transactions which are under the FEMA purview, I would like to break into two broad segments, which is the capital account transactions and the current account transactions. Let's talk about the current account transaction first. That's an easy one, right? So the current account transactions are import and exports. It could be goods and services and remittances, whatever you can see, right? These are controlled, assessed, valued, appraised, whatever you may like to put it, at the customs frontier. The regulatory machinery has already created a Customs Act. The rules and the guiding principles under those Customs Act are actually people who are sitting there, who are assessing, who are appraising the value of such goods and services, imported or exported, so that the transaction between an Indian enterprise, an Indian person or Indian entity, and a foreign enterprise, a foreign person or a foreign entity is at a fair value, because there are custom duties impacts involved. There are multiple other compliance requirements that come into the picture. And obviously, an import and exchange transaction, export transaction has a huge potential in making a country's economic growth possible. So that part of the story with this under the FEMA is being currently parked within the purview of the customs appraisers and customs authorities. You'll have to file a bill of entry when you import goods, a shipping bill when you export goods. Even in case of services, the software export forms called SOFTEX have to be filed, which are being assessed at the Software and Technology Parks of India level, STPI level. So there is some mechanism being built somewhere to evaluate, assess, and identify the right value of the transaction. Moving on to the capital account transactions. Capital account transactions are broadly categorized into two kinds, right? Debt instruments and non-debt instruments. So in case of debt instruments, there are specific guidelines that are available. One of the most popular ones is the external commercial borrowing guidelines, ECB guidelines. Obviously, over the years, relaxations have been made into the guidelines, and the guidelines are essentially more self-regulated under an automatic approval route, and people are able to transact very easily these days, keeping the AD or the bank in the loop, which is the watchdog or the regulator on behalf of the Reserve Bank of India under the FEMA regime. The real challenge with respect to valuation, with respect to assessing what's the right transaction value, comes in case of non-debt instruments. Non-debt instruments, very broadly classified from a layman's point of view, if I kind of put it, is essentially a document or an instrument which kind of gives you a ownership or a control right into an entity. It could be in any form, it could be equity, depository receipts, convertible securities, warrants, ESOPs, preference shares. And there are many modes and manners to issue them now with the ever-changing industry landscape and the creativity that we see in today's startup world, right? From convertible notes to drag along rights and warrants. I know new terms keep coming up every day where people or entities or non-residents and including residents are being given rights into non-debt instruments and a right into the ownership structure of the company. So this is where today we are going to try and focus our discussion on and talk about how these valuations are conducted under the FEMA regime for listed and unlisted entities. So valuations under FEMA has kind of evolved over a period of time. So what used to be earlier used to be an agency called CCI. I'm sure a lot of us would have read about it. I've even had the honor of doing some practice work also into this. The controller of capital issues was the agency which used to oversee the Indian capital markets until a time, the Securities and Exchange Board of India was created, I think somewhere in 1992, if my memory serves right. Now, the CCI in its good old days had actually created certain pricing guidelines under which the valuation of equity and instruments was being conducted. And despite the CCI's redundancy, its pricing guidelines still remained relevant and in fact gained importance due to India's aim to attract foreign direct investment. These SEBI-regulated listed entities were also covered under these guidelines. While most FDI transactions at that point of time in India were in the unlisted entities. So the pricing guidelines which were formulated by the CCI became the guiding principles for foreign direct investment in India. Over the years, the RBI has been, in my opinion, it's my practice opinion of about 20 years now, I've seen RBI as the most evolving organization from a regulator point of view. They're up there with the changing market scenario, changing industry landscapes, and changing ways of doing business. So somewhere around 2008, 2010, when we were trying to open up our economy, and we were seeing the inflow of foreign direct investment in India, the RBI also was getting into a lot of relaxations to kind of ease the foreign exchange transactions. Convertible instruments were introduced. And by, I think, 2010, if my memory serves right, most sectors were liberalized for foreign direct investment. There are certain prohibited sectors that still exist, but that's not the point of discussion today. but most of these were liberalized in some form or the other. And we keep seeing that liberalization happening these days as well. Now, during this period, issues related to indirect foreign investments and control had become prominent. We could see cases where non-residents paid a far substantial higher value than the fair value for the Indian shares because they were being given, they were paying for control premiums and to gain economic power beyond the equity capitalization tables. So RBI was aware of all of this because transactions were all happening through them. Now, to address these issues, the pricing regime was reviewed in 2010. That the pricing regime, by that I mean that the way equity had to be valued from a foreign direct investment perspective, the pricing regime was reviewed in 2010. And this change allowed valuation to be determined by a SEBI registered merchant banker or a chartered accountant using the discounted cash flow method, DCF as it is popularly known as. Whereas DCF faced a lot of criticism, and we know that DCF already has multiple challenges. It's too complex, in my opinion. Forecasting is a big challenge. What is DCF? Under DCF, you try and forecast the future cash flows of a business or an entity, under which you will need to kind of first draw their P&L, identify their cash flows, create their financial statements. There is so much assumptive things which are taken into consideration while you do a DCF valuation, DCF-based valuation. Because you're trying to continuously assess what the business has to go through. And it's in this changing industry landscape, economic scenarios, regulatory environment being changed so frequently, it becomes extremely difficult for someone to reliably estimate, forecast the entity's future cash flows. It's very assumption sensitive. And the most important thing is the historical data that we have in India is not in a structured format. We don't have tons and tons and years of historical data which has gone through multiple economic cycles. And we know how the businesses are expected to perform in a certain kind of an economic cycle. Regulatory technology changes keep impacting just look at the way CDMA technology died when GSMs came in. And when 4G and 5G have come in, other telecom companies are also kind of finding it hard to survive in this scenario. So everything put together, it was a very subjective, rigid, and it was a one approach fits all kind of a situation which the RBI, tried to bring in. This is where I love to quote Mr. Warren Buffett. Managers and investors alike must understand that accounting numbers are the beginning, not the end of business valuation. Now, RBI being as evolving and as smart as always, in 2014, they went in for another change. And the path-breaking valuation mechanism and methodologies were introduced, which are currently being used for both incoming and outgoing capital account transactions. And we popularly call them as any internationally accepted pricing methodology. Now, IAPM, right? That's what generally it's referred to as. And arm's length concept was also introduced in 2014. Now, changes made in July 14 were to determine fair value of equity and convertible instruments using any internationally accepted pricing methodology. Transparency was mandated, requiring valuation, details, pricing methodologies, and certifying agencies' information to be provided. And once again, it was practicing chartered accountants, SEBI-registered merchant bankers, and practicing cost accountants who were allowed and brought into the foray, wherein they could come and certify these. And these pricing guidelines have evolved over the years, becoming more liberal and accepted, but there will always remain certain concerns. and those concerns will have to be over a period of time addressed. So 2019, RBI did a big jig and big shakeup, wherein the foreign exchange management non-debt instruments rules was introduced. Now, these rules currently are relevant, prevalent, under which all valuations under the FEMA environment with respect to financial assets and securities are being conducted. Now, Rule 21 is the guiding rule under the NDI rules, which talks about these scenarios, the permissions, the RBI mandates, the FEMA mandates under which the valuation needs to be conducted. Now, pricing guidelines under Rule 21 broadly breaks the transaction into two kinds of transaction. One is obviously the listed entities, and any transaction by way of a transfer or a sale or whatever in accordance with SEBI regulations is not covered under the pricing guidelines under Rule 21, because SEBI overrides the transactions and essentially covering the listed entities. So we're not covering that aspect today. That's an independent discussion and a whole session on its own. But every other transaction, primarily a transaction in an unlisted entity, are covered within the guidelines of the NDI rules, Rule 21. What kind of transactions are we referring to? As we discussed earlier, these are transactions between residents and non-residents. Either ways, right? Resident to non-resident or non-resident to resident. Rule 21 defines the valuation principles around which these valuations have to be conducted. The concept of less than and more than was also introduced during these guidelines. So what is that concept of less than and more than is extremely important in context of the transaction. Rule 21 also identified the persons or the certifying agencies whose certifications or valuations are acceptable under the FEMA regime for a transaction to sail through the approval or the reporting requirements of the FEMA. So under FEMA, if I kind of just deviate a little bit, how does the transaction happen? Let's say, for example, you incorporate a company. It could be a wholly owned subsidiary or a JV or whatever, in which there is a foreign participation. If there is foreign participation, then obviously money will come into the country as foreign direct investments. If your line of business is under the automatic route of approval under the foreign direct investment guidelines and the permission that exist in the country right now, you don't need to seek any approval. You get the money. The money hits your bank account. The bank account activates the AD, the authorizer in it, and the AD starts interacting with the remitting bank, gets certain details. You are given that money, cleared that money within 24 hours of submitting all details. That money is free to use now, and your reporting requirements start from that day. It's our post-transaction reporting requirements, whether it is submitting the KYC forms or equity declaration or Form FCGPR, along with all the documentations and valuation reports and everything. These are only post-transaction compliance requirements that kick into the picture. And one of the attachments to the compliance requirements is a valuation report. This is where Rule 21 comes in, that how are the equity or financial instruments valued so that relevant reporting can be done. The AD, being the watchdog of the RBI, is reviewing that particular transaction, that report. And if it's compliant to the NDI rules and guidelines, the transaction is submitted to the RBI for a final okay or a go ahead. And the RBI then completes the FDI reporting formalities. And this gives you a full repatriability of your investment when the transaction is accepted and controlled by, approved by the RBI. And obviously, delays in reporting want you to submit late submission fees, and regular compliance issues may refer the matter to compounding as well. The concept of less than and more than is an extremely important concept to understand from a FDI perspective or a valuation perspective. So, what Rule 21 kind of arrives at or hints at is that there has to be a fair value of every transaction that comes in. Now, once you've added a fair value within the principles and guidelines of Rule 21, the transaction nature is looked at. So, if it's a transaction from a non-resident to a resident, that means, for example, let me just kind of put it very simple for you. If a resident Indian is buying an equity instrument of an Indian entity or an entity abroad from a non-resident, the transaction value of that particular, buy or sell buy arrangement cannot exceed the fair value as determined. You can buy at a lower rate under FEMA, which is permitted, but you cannot exceed that fair value because the FEMA guidelines does not permit that. But if it's the other way around, if a resident is transferring its stake or selling its stake or issuing new shares or whatever to a non-resident, then that transaction cannot be less than the fair value. Mind you, cannot be less than the fair value. So you see a protectionist attitude approach of the regulator in this. They're trying to protect the resident from an undervaluation or an overvaluation of a financial instrument either ways. They're trying to protect the Indian economy and they're trying to protect the foreign exchange transactions in the country. So that particular protectionist attitude has been there since quite some time now, even before the 2019 guidelines. But 2019 guidelines kind of sealed the entire discussion, didn't leave any scope for ambiguity in this. The most critical and the most important aspect of valuation is that FEMA, it's one overriding act that we are talking about today. But any transaction, whether it is, issue, preference, right, bonus, merger, ESOPs, derivatives, whatever it is, does not just have one, regulator to satisfy. In India, if you are a company, you also need to, comply to the Companies Act 2013 and the guidelines around it. And obviously, if it's an asset which involves an Indian asset or it's a transaction which involves an Indian resident, the income tax will also get up and say, dude, where is my share? So India is a complex regulatory jungle, but so be it. That's where we live. That's where we thrive. So whenever a valuation is done under a FEMA, from a transaction perspective, from a valuer's advice perspective, from a chartered accountant's perspective, it becomes imperative for all of us to assess that transaction under minimum these three buckets. That I must be doing a transaction which is very well captured and supported within the FEMA rules and regulations, within the Companies Act reporting requirements, and it's also satisfying the income tax requirements. That's something very, very critical for a transaction, more importantly, a valuation to kind of sail through within the regulatory environment. You might be in an automatic route, a business. You might decide to go into for an approval route transaction. But satisfying valuation under these three buckets becomes imperative, mandatory, important for a transaction to kind of sail through the regulatory test in the country. Now, when I talk about, issue of shares, which is so we're going to kind of from here on we're going to try and focus the discussion on two broad segments, as we said, the incoming foreign investments and the outgoing overseas investment. So we're going to talk about the incoming first, which is the foreign direct investment aspect, and then we'll follow up with the ODI or the overseas investment aspect, in the next part of the session. So currently, when I talk about a company, so I mean, if I look at the FEMA landscape right now, the permission to invest is available under the Companies Act in a Indian private limited or a limited company or an Indian listed company. It also permits FEMA also permits investments in LLPs. So when I talk about issue of shares, I am talking about essentially issue of shares by an Indian company. And that issue of shares can be done in multiple ways. It could be a fresh issue by way of a preferential allotment. I could give a rights issue to my existing shareholders. I could also conduct a private placement drive, which is very common these days in startups and venture capitalists and growth companies. I might decide to give bonus issues to my existing shareholders. And obviously, ESOPs are an integral part of any business growth these days. The companies regularly buy back shares to give something back to these shareholders and investors. Issue of shares can be for cross-border transactions. I'm sure you would have heard about the cross-border transactions in the previous sessions, and a detailed discussion would have happened there. So we're not going to touch that. But a cross-border transaction, an M&A transaction, is covered by special rules under FEMA Cross-Border Regulation 2018. That's where things is happening. Now, if there are shares, they are bought and sold. When they are bought and sold, once again, the three transactions come into the picture, which is resident to non-resident, non-resident to resident, and non-resident to non-resident. So these three kind of transactions always come into the picture. And each one of them are specifically addressed in the rules, the NDI rules that are the umbrella under which the valuations are being conducted. And sometimes you really do feel a challenge with respect to, in the transaction, who should value? What should be the valuation method? Who should be the certifying agency? Will I have a tax situation? Will the Companies Act permit this? This is a tricky situation, mind you. This is where it's imperative to have a good understanding and knowledge of all the three kinds of valuation requirements and identify the transaction and kind of conduct that transaction in a seamless manner. So what I've done, so now if I talk about the valuation methods, we've been hearing about any internationally accepted pricing methods. When I talk about any method, I mean, there are plethora of methods in this world today. DCF being one of them, NAV being the other, comparable transaction analysis, comparable company analysis, asset-based valuations, earning multiplier approach, liquidation valuation, replacement cost method. Then you have option pricing models. You have market capitalization methods. You have special valuation methods, which have actually become very popular with respect to startups. Now, which method to follow? RBI under FEMA regime has clarified that any internationally accepted valuation methodology which gives the fair value of the instruments is something which can be easily followed. But does the Companies Act and the Income Tax Act permit that? That's where the transactions start becoming complicated. That's where you need to apply your thoughts, your mind, read within the regulatory environment framework in rules and regulations, and identify what is the best mechanism under which these investments can be completed. So I've tried to simulate something here for the benefit of all of us. And I've tried to kind of compare. It might be repetitive quite a lot, but then there is some difference or the other in the multiple manners under which the shares are being issued and valued within the compliance framework. So if I look at the fresh issue of share capital by an Indian entity, I think it's the most common thing. Now, what does FEMA say? Once again, any international methodology, and a chartered accountant or a cost accountant or a merchant banker can easily certify and value it. But does Companies Act accept it? No, the Companies Act wants a registered valuer to conduct the valuation. Whereas if you move to income tax, Rule 11 UA, 11U will come into the picture. And income tax says if it's an NAV valuation, which is the method of valuation, net asset valuation, then a chartered accountant or a merchant banker is certified. But if it's a DCF valuation, only a merchant banker needs to certify it. So who can value, and the method of valuation is switching. So FEMA says fair value as calculated under any international accepted pricing methodology. Companies Act says any international pricing authority, but valuations conducted as per the Rule 8 of the Company Act 2017 under the guiding principles of the valuation standards adopted by any registered valuer organization. A lot of scope of standardization here still remains. And on top of it, our good old income tax comes in and says NAV and DCF only. Now, there have been some changes with respect to the last budget with respect to overseas investment. We'll talk about that when we come later. Subsequently, if you want to conduct a preference allotment to shares under 62(1)(c), similar rules apply. But under income tax, it's only required when you're doing it at a premium. Otherwise, it's okay. If you're doing a private placement, once again required only when you're doing it at a premium. Otherwise, it's okay. All the other remain same. Registered value under the Companies Act, Foreign Exchange Management Act, chartered accountant, merchant banker, listed entities go under the SEBI guidelines, fair price to be calculated by international methodology. All those remain same. With respect to mergers and acquisition, obviously it's referring to a special regulation, as we just said. And that special regulation is the Cross-Border Mergers Regulation 2018 of Rule 25. Now, what happens in a merger and acquisition transaction? I mean, I'm not taking this up in detail, but a quick one to just make you relate to the entire story. When if it's a cross-border merger, obviously there are two separate countries, two separate geographies that are involved. And when two separate country geographies are involved, obviously the valuation professionals of two countries are involved. Sitting here in India, I don't think we are doing justice to valuing a company somewhere outside the country. So this is where the FEMA and the RBI came up with a a regulation that members of the recognized professional body in the jurisdiction of the transferee company will be entitled or will be allowed or will be acceptable to sign the valuation report. The method, once again, has been kept same as the standardized general method, which is the any international accepted valuation standard method for an unlisted entity. For a listed entity, obviously the SEBI guidelines will come into the picture. Income tax still wants NAV in this scenario. Transfer of shares is something which is very common and prevalent in any transaction which involves transfer of shares between a resident and a non-resident. It's simple, once again, the transaction is very simple. When you get your money, you declare certain, you file certain forms, make some declaration to the AD. Excuse me?
If it starts using the card, if it start using the card, then that and auto approximately comes out to the same price.
And there's some background noise. Can we mute ourselves, please?
No, auto, I think.
Yeah, thank you. So when there's transfer of shares between residents, non-residents, NR to R, whatever, that particular transaction is simple. You get the money into the bank account, make some submissions to the AD, and when you made the submissions to the AD will clear the transaction, put the money in your account, but you're expected to submit form FCTRS. And that FCTRS, along with other submissions, has to have a valuation report as an attachment. That's why the valuation also becomes imperative if there are two individuals who are transacting. So I, as an individual, could transact with another individual in a foreign country, but I still will be required to prepare, submit, and send out my valuation report along with the other submissions for the transaction to be finally approved. Now, from an NR to NR perspective, RBI is pretty silent about it. It doesn't talk about it too much. But the valuation guidelines, since it involves an Indian asset, automatically points out to the fact that even that transaction must be conducted at a fair value. And what is fair value? Once again, fair value will hint at the valuation guidelines and the principle that are given in the NDI Rule 21. And NDI Rule 21 is important because the transaction may not involve an exchange of consideration between two non-residents from an Indian perspective, but it still involves other compliances with respect to the Companies Act. You've got to retire your stamp duty, share transfer stamps, and everything else. And also the fact that if it's an Indian asset that's involved there, or if an Indian resident that's involved here, you need to do your income tax compliances also. So even for a transaction which does not involve a direct inflow or outflow of foreign exchange convertible in and out of the country, it still needs to be at a fair value. That's what the whole intent here is. So when we move on, you might have some obvious questions, and there are certain special cases that we talk about all the time. And those special cases may have a slight different way to look at valuation. We'll try and address some of these cases now and talk about it. So for example, you are incorporating a new entity. A new entity is not expected to have any valuation. It might have a valuation in today's concept because there might be some self-developed IP and all that in the startup world today. But essentially, when you incorporate a new company, and if a wholly owned or a partly owned subsidiary is being incorporated, you decide to contribute subscription to the memorandum of association. Here, an exception exists in the rules that, okay, fine, as long as that contribution is being done at a face value, is considered to be a okay valuation or an acceptable valuation. Because obviously, when a new company is incorporated, you don't expect that to have some kind of valuation method to be followed. So the RBI guidelines permit face value as the acceptable fair value in case of subscription to the memorandum of association. Now, every subsequent transaction post that will require adherence to valuation guidelines in the non-debt instrument rules, Rule 21, as we've been harping on again and again. Now, we've seen scenarios where swap happens. Cross-border merger is one of them. There could be independent swaps also. People might, issue shares in lieu of some things, may get shares in lieu of something. And this could be, and obviously this is cross-border, that's why we're talking about it. And if it's cross-border, what does the guideline say? The rule says, it's the merchant banker, SEBI registered merchant banker, or a registered investment banker under that country's regulation whose valuation reports are acceptable as the value of the swap of shares. Once again, the merchant banker in India, SEBI registered, or let's say an investment banker in the US or Singapore or whatever it is, whichever country it is you're transacting with, that country's registered investment banker is something which is an acceptable valuation from a swap perspective. There are situations where you have partly paid shares. There are situations where you have warrants. But the RBI, the guidelines and the intent is extremely clear that I want you to determine the value of those shares, whether partly paid or future convertible or whatever it is. The determination of that value of the equity participations must be done today at the date when those transactions are being consummated. You might call for the next tranche of money 6 months later, 3 months later, 1 year later. But that call has to be at a valuation which is determined today, submitted to the RBI, and gotten, reporting completed for. I won't say approval, got a reporting completed for, because I'm expecting that you are in the automatic approval mechanism route. Similarly, even if you are issuing warrants, the valuation for those warrants need to be determined upfront. And when I'm determining the valuations upfront, the conversion of those warrants, whenever it happens, should not be less than the value, the fair value determined at the time of issue of the warrant. That's what the pricing guidelines talk about. Once again, ignoring if something is being done at a listed entity level. I keep coming back to it because at that transaction level, the SEBI guidelines will override the valuation mechanism, shared here. If there is a transaction of allotment of shares other than cash, is generally permitted only in case of capital goods or machinery being imported. And when it is capital goods or machinery being imported, obviously you'll have the custom frontier. And the custom frontier would talk about the valuation of the machinery and the capital goods. That's the consideration for the goods that has actually happened. And for that consideration, you will issue an equivalent amount of equity shares. And the equity share valuation will be, once again, the same rules will follow with respect to any international accepted method at fair value. There is also a special case where companies who are incorporating, the foreign entities who are in the process of incorporating Indian subsidiaries or JVs, do a lot of pre-operative or pre-incorporation kind of expenses. Against those also, you're allowed to issue certain shares. But those shares, there are limits prescribed under the relevant regulation. And within those limits only, you can kind of allot shares up to that value. But once again, the allotment has to happen. And generally, in all practical sense, these kind of transactions will only be in case of new companies. So I am expecting that generally, there could be exceptions. Generally, there could be face value transactions only because they are new companies, and subscription to MOA and AOA or equivalent transactions will only have to be followed in this case. Now, as we had discussed earlier, in addition to companies under the Companies Act 2013, investment in an LLP by way of a capital contribution can also be done by a non-resident. Once again, investment in an LLP either by way of contribution or by way of acquisition or transfer of profit shares should not be less than the fair price worked out in a valuation norm which is internationally accepted or adopted as per market practice. And that's what we refer to as fair price of the capital contribution / profit share of our LLP. And obviously, a valuation certificate to this effect has to be issued by a chartered accountant, a practicing cost accountant, or by any approved valuer from the panel maintained by the central government. Merchant bankers are out here, you see a difference? Because merchant bankers generally regulating companies, not LLPs. Now, in case of a transfer of a capital contribution, a transfer of capital contribution or a profit share of an LLP from a person resident in India to a person resident outside India. So once again, a resident Indian is transferring his shares or his profit share or his capital contribution to a person resident outside India. The transfer should be for a consideration not less than the fair price of capital contribution or profit share of an LLP. So you see, once again, that less than and more than concept has come into the LLP aspect also here. Because it's once again the protectionist attitude of the regulator and to give a level playing field to both forms of business, whether it is companies or LLPs. Similar provisions are, similar rules are drafted within the NDI rules. And if we read that entire, clause the other way around, so in case of a transfer of a capital contribution or a profit share of an LLP from a person resident outside India to a person resident in India, the transfer should be for a consideration which is not more than the fair price of the capital contribution / profit share of an LLP. So there is no harm, or no harm is the wrong term to use maybe. The RBI or FEMA guidelines do not restrict you from selling at a value of more than the fair value, because you're earning foreign currency for the country, but it will not permit you to transfer a share at a value which is less than the fair value of the transaction. And the other way around, it will not permit investment by a non-resident into an LLP at a value which is less than the fair value. It doesn't want to give away control to a non-resident at a value which is an unfair value. So that's the intent with which the LLP, valuation guidelines are also taken care of. So moving on, I think the next part of the deliberation here would be so that's pretty much with respect to incoming transactions of foreign currency, the foreign direct investment part of the story. And obviously in this creative, complex, new age world, there could be multiple other transactions that one can envisage, think of, and I'll be happy to address them in the Q&A section if you have some thought process. And even if I'm not able to address it right now, I'm happy to take it offline with any one of you to discuss the transaction further, because it's very difficult to kind of cover each and every kind of transaction in a incoming foreign direct investment kind of a scenario, because it's a very creative world these days. People have become very creative in terms of identifying the kind and type of instruments that will help someone gain a equity participation into the business. So moving on, what we will now shift our discussion and deliberation on is the overseas transaction, which is the outbound transaction. Right? The outbound transactions are essentially overseas investments. So August 22, the new OI regulations were kind of released by the RBI, and they've been game changer in a lot of other aspects. We'll focus ourselves into only the valuation aspect of the story, though it's a far-reaching consequence, and a lot of things have been eased off. Some permissions have been granted. It's become more compliance, more industry-friendly. And it's a far, it has far-reaching consequences with respect to the overall overseas investment kind of a scenario, because India is in a position that we see a lot of overseas investment going out of the country right now. So The pricing guidelines which exist in the Overseas Investment Directions 22, we are going to talk about that. But before that, let me just kind of give you a broad, structure of the overseas investment. So essentially, overseas investments is permitting overseas direct investments and is also permitting overseas portfolio investments, ODI and OPI, as they are popularly called. Once again, the whole story around the ODI and OPI guidelines revolves around the pricing guidelines, and the pricing guidelines point out towards arm's length, internationally accepted. So before facilitating the overseas investment, the AD generally ensures compliance to Rule 16 of the OI rules. It talks about documentation, board approved policies, and the consideration of the valuation as per an internationally accepted pricing methodology. And the transaction can be sailed through once you are following the guidelines laid down under the OI Regulations Rule 22. Now, when I talk about overseas investments, who all can do this, investments? Obviously, an individual can also do it, or a corporate entity can also do the investment. An LLP can make the investments. So what does the guideline provide for? The guideline provide for that an individual is permitted to use the automatic route up to US dollar 250,000 per annum. That's a calendar year under the FEMA guidelines, under the liberalized remittance scheme. This 250 is an overall umbrella under which his foreign transactions have to fall in. It could be ODI, it could be family remittances, it could be family remittances, it could be travel related kind of payments. It could be any kind of education payments for your family, kith and kin. But everything has to fall within that umbrella of $250,000 in a year. Anything above that will need an approval, a specific approval based on certain things. Oh, there are certain exceptions to this with respect to medical and stuff like that. We're not getting there. But then anything beyond this in a normal course of scenario, including your debit card swipes, are covered here. Right? Debit or credit card swipes are covered here. Will need an approval. Anything beyond this will need an approval of the RBI. With respect to a company or an LLP, the guidelines are similar or same for both the scenarios. You are allowed to invest 400% of net worth, up to 400% of your net worth. And net worth in accounting scenarios means share capital plus free reserves. We all know that. I'm not getting there in terms of what is net worth. So you're allowed to invest up to 400% of your net worth or any amounts that are lying in the resident foreign currency account. So there have been situations in past where we've been able to use this effectively. The company may have a poor net worth, but is an exporter of goods and services and recovers money in the EEFC account, which is the Exchange Earners Foreign Currency accounts, and holds it. And that money can also be used to make the foreign direct investments, make the overseas direct investments into subsidiaries or joint ventures outside the country. Once again, anything and everything above that would need an RBI approval. Pricing guidelines are pretty much similar in terms of what they were in a FDI kind of a scenario. There has to be an arm's length. It has to be done on a valuation methodology that's acceptable internationally. That's something which is essential and integral to the entire NDI rules that came up in 2019. Now, who is permitted to certify these valuations? That's something which is a little different here from the other thing. So if an ODI investment is greater than a USD 5 million, only a SEBI registered category 1 merchant banker is permitted to sign the report. And in case if the investment is by way of a swap or a swap of shares of a foreign company and an entity, once again, only a SEBI registered category or merchant banker can sign the report. In all other cases, a chartered accountant or a CPA, as you discussed earlier, is permitted to sign the report. And that report is acceptable under FEMA compliances. We are not talking about what is acceptable under Income Tax and Companies Act here, because that's a different discussion that we started and touched upon a little bit earlier. But within the FEMA compliances, this is permitted. Very important thing that we kind of should cover within this assessment of what is the kind of valuation under this thing is rules is the pricing guidelines do not apply if you are bringing in investment into an equity instrument on a non-repatriation basis. Or why would you generally do that? But if that happens, then obviously the pricing guidelines do not apply. And as principally discussed earlier, as principally given very clearly in the India rules earlier, any transaction of sale or transfer or whatever you may call it, if it falls under the SEBI regulation, where the pricing methodology is prescribed under the SEBI guidelines with relevant rules and regulations, the pricing guidelines need not be enforced on. But obviously, when you're going in for a transaction of an FCTRS or an FCGPR or whatever it is, then a chartered accountant's certificates is an important filing document which has to certify compliance to the relevant SEBI regulations and rules and guidelines, which must be a part of the entire documentation submission that you are doing to the regulator. That also becomes an important aspect here from a practice perspective. Another important aspect that is being touched by the non-debt instrument rules is that the validity of the valuation report. So obviously, we've discussed for the last about 1 hour or so that valuation is an important aspect in respect of any FDI and ODI transaction. And a valuation report becomes extremely important because businesses, economies, business scenarios change so frequently these days that you cannot have a valuation report being done today and used 2 years later. No, it will not have any sanctity or validity around it. So generally, all FDI ODI transactions must be completed within 6 months from the date of taking that valuation report. The AD, who is the regulator in chief, the operational regulator here, ensures that they do not accept any valuation certificate issued by a chartered accountant or a SEBI registered merchant banker or a practicing cost accountant, which is more than 90 days old from the date of transfer or transaction. We've actually experienced that in past, and we've had challenges in practice here on this. That even if you have a valuation report, even late submission at times have become a challenge with respect to the fact that your certificate is dated more than 90 days old. So the date, the validity of a valuation transaction becomes imperative here in this. So before I come down to my concluding remarks, there is one particular angle that I'd like to point in. Maybe just to go back a little into the FDI aspects. So, remember we've been talking about less than and more than kind of a concept. So, a recent change in the budget, which is now this budget, has also kind of put a break into the transaction, the more than transaction here. Let me kind of do a small, case analysis here, which is bordering around the investment by a non-resident into an Indian entity. So what does the FEMA guideline says? that if a non-resident is talking about investing in an Indian entity, the FEMA permits that, okay, you arrive at a fair value, and the non-resident must be issued shares at a value which is not less than the fair value. More than pay, there is no restriction, right? But in the current budget, investment from non-resident is also now covered under the ambit of Section 56. Earlier, the investments from non-residents were not a part of Section 56 because they were covered under FEMA. An application and a CA certificate was submitted before the banker or the RBI, and it would sail through. But in this, budget, these lawmakers have covered this transaction also within the ambit of the section, and there are new proposed draft rules which have been issued, I think, in May 23 for public comments, and where the options have been given to this SC. Now, income tax is also seeing a little bit of change here. See carefully. Instead of an NAV, you can also do NAV, DCF through a merchant banker, and there are separate rules for venture capital undertakings. And they are giving you various choice of various methods: comparable company method, probability weighted expected return method, option pricing method, milestone analysis method, and replacement cost method. Some of these have been brought into this thing. These are still in nascent stages, are being in the process of kind of finalized. But I just wanted to bring it in before, kind of moving on to the closing remarks. Well, that's very recent. So if you see here, the way even the tax landscape is changing. Not that it still just wants the NAV or merchant banker or this thing, because they understand that there is a need to align the valuation requirements under the various acts. So I just wanted to kind of sign this off before I kind of come on to the concluding remarks of the presentation. Yeah. So essentially, once again, summarizing overall, if the issues by an Indian company or LLP or transfer from resident or non-resident, the price should not be less than. For listed entities, we're talking about SEBI guidelines. For unlisted entities, we're talking about any internationally accepted pricing methodology arriving at the fair value of the shares, duly signed by CAs, merchant bankers, and cost accountants. Transfer from a non-resident to resident, the price should not be more than the fair value. The valuation methodology remains the same. For ODI transaction, we discussed just above, merchant banker, if the transaction is more than USD 5 million, all other cases, CPAs and CAs are allowed to sign, and swap of shares essentially between a valuation to be signed off by the merchant banker or the registered investment banker of the other country. The other country. So during this, I have placed reliance on the following, legislative differences, which are the master directions of foreign investment in India, consolidated FDI policy, foreign exchange management non-debt instrumented rules, amendments, directions, the RVO, the company register value rules, CCI guidelines, DCF method, IAPM, and revised pricing guidelines. There's a link to all of these on the slide. I'll be sharing the entire presentation with the Honorable VSB, and the Chairman Sir can maybe direct further for sharing further. I'll be concluding my remarks here. Happy to get on a personal call or anything with any one of you, and please feel free to write to me, and happy to take up any questions that you have. Thank you.
Okay, so thank you so much, sir. And now we are going to start with our Q&A session for today's session. So we will start with our first question, sir. So the first question is, how do we value optionally convertible debentures / preference shares?
Okay. In case of convertible equity instrument, the price of the conversion formula of the instrument is required to be determined upfront at the time of issue of the instrument. Now, the price at the time of conversion should not in any case be lower than the fair value which is worked out at the time of issue of such instruments. And obviously, the extant FEMA rules and guidelines will automatically follow here, because the valuation of these instruments have to be done under an internationally acceptable valuation methodology. For example, if I talk about ESOPs, Black-Scholes models is the most popular model under which the valuations are being conducted. So there is not a straight answer to how do you value. The FEMA guidelines do not talk about how to value. It talks about what is the right valuation method. And identification of the right valuation method is with a professional whom you're working with.
Okay. So the next question is, for conversion of a compulsorily convertible instrument into equity issued earlier, whether a valuation report is required at the time of this conversion under FEMA and to be submitted along with FCGPR.
Okay, so as I rightly said, FCGPR is a form that has to be submitted along with your incoming foreign direct investment filings to get a final okay from the regulators for the transaction to be at a repatriable basis. And the answer to this question also lies into the earlier answer, because a convertible instrument, whether optionally or compulsorily, is giving you a right into the equity participation of the business. And when you are getting a right into the equity participation of the business, it's imperative that along with Form FCGPR, a valuation report must be submitted as per the guidelines that are issued in Rule 21 of the NDI rules.
Okay. So the third question is, can a resident Indian give shares of private limited company to an NRI in blood relation, and any permission required? And the second part of this question is, how are shares valued?
So how is again a question that comes obviously keep coming up, because these are specific transactional discussions that people want to do here. But from an how perspective, it's always an internationally accepted pricing methodology. Which methodology to use is independent to each transaction. Yes, gifts can be done, but a specific RBI permission needs to be taken.
So the next question is, sir, can valuation of shares can be done for a company which is yet to be incorporated in a foreign country? Right now, the proposed promoter has been issued availability of name on.
Okay. This is a specific question, or maybe a specific transaction the person is going through, maybe. But try and appreciate that if you are incorporating an entity, that means a resident is buying a stake as a subscriber to the memorandum or charter of that entity. And that memorandum and charter is allowed to be invested at subscription values. So your subscription values should be the initial investment mechanism into the company. Post that, a fair value assessment of the transaction value can be done in order to invest additionally into the overseas entity. And for face value investments, you don't need a valuation report. And for face value assessment investments, you just need a clarification and a documentation which clarifies that this investment is being made at face values.
Okay. So proceeding further, sir, we have come up with very interesting question that somebody has asked. One of my clients in blood relation, one of my client's sister actually wants to send 10 crores to him from US. Okay. So is any restriction on setting such money or any taxability arise on assessing to purchase real estate in MP? I think that is the second part of the question. And any FEMA requirements needs to comply. I think, sir, you should charge for this question as one
No,
of the client systems sending
so
10
which is
crores.
fine. Which is fine. People attend these forums to get some insight into the transaction only. And yes, all your fears are right in terms of client sister sending in 10 crores to invest in real estate. Please make sure the ED doesn't come after you, and you are not reported in the enforcement director for sending this kind of money. I'm sure you are all compliant in that respect. But I think the transaction the has to be done on merits, and since it's a large value transaction, I'll refrain to hold a comment onto this because it needs to be investigated, reviewed from various different angles, as it has impacts under FEMA, income tax, as well as the sector in which you are infecting, because real estate also has certain prohibitory clauses. So be careful when you consummate this transaction, please.
Okay, sir. So the next question is, for valuation under FEMA NDI rules, CA merchant banker can do the valuation. But for ESOP option, valuation only merchant banker is authorized. Is it so, sir?
Yeah, that's right. The answer to the question is in the question itself.
Okay. So, sir would like to say that, yeah, your question is very correct that for ESOP option valuation, only merchant banker can do it. So, proceeding further with the next question, is pricing guideline applicable to non-resident in
Come again, please.
is pricing guideline applicable to non-resident Indian national also?
Non-resident Indian national.
Yeah, non-resident Indian. I think he would like to ask that is pricing guideline applicable to NRI also?
Yeah. So pricing guidelines. So let me just kind of open and share one more thing with you, which will kind of clarify this doubt. Just give me a second. I can just quickly find this. So I'm going to try and go to the title of the pricing guidelines. I think I have the file open with me. The applicability is on any incoming foreign direct investment. So when you're talking about an incoming foreign direct investment, the money has to flow from a foreign source to be able to become fully repatriable. And when the money has to be becoming fully repatriable, then obviously the pricing guidelines will kick into the picture. But if you're not interested in repatriability of the money, as I said earlier in the presentation, the pricing guidelines are not applicable.
Okay. So the next one is, under RBI Circular 142 of 2014, Indian branch office of foreign company can transfer its assets to its wholly owned subsidiary or any entity at sale consideration which is not more than book value. How does a company comply with this, and whether this is permissible if it is not at fair value or arm's length price determined in accordance with transfer pricing regulations?
So once again, this is a very specific question. And I think to answer this question, it's very important to understand the income tax applicability on the entire transaction as well, because a branch office is nothing but an extension of the arm of the principal office. Yes, the branch office regulations certainly permit transfer at a book value, and book value will have to be certified. And this will permit the certification of that book value will permit transfer of these shares from a branch to the entity. And this will require a specific reporting requirement within both the branch guidelines and the NDI rules guidelines. But then I think I would reserve a professional comment on this, because this is once again a very specific question. There are more facts to be examined in this. before we make a full statement of facts on this or answer to this.
So, proceeding to next question. In case of deferred payment of consideration, where the holdback value needs to be paid after few days/months, then please guide on below points. First is valuation reports about to change post holdback adjustment, then how to tackle authorized bank to file FCTRS file.
Can you repeat the last sentence? I couldn't understand that, please.
Valuation reports about to change post holdback adjustment, then how to tackle authorized bank to file FCTRS file.
See, once again, a very specific practice level question, but if I'm talking about a deferred payment plan, the issue of the instrument has happened earlier. And we've already discussed that if an issue is happening on a partly paid or a deferred payment plan or an option convertible, the price has to be determined upfront. And when the price is determined upfront, I really don't see why the challenge is arising with respect to the bank. Well, the determination of price has happened with respect to the issue of the shares at the time of the issue of the shares. So I don't know why bank is kind of, objecting to this. The guidelines are clear in this.
We have a second part related to this question only, that in case NR is a company and one share held by nominee shareholder on behalf of company, then do we need to make two FCTRS filings?
If NR is a company and one share is held by a nominee shareholder on behalf of the company, now the transfer is happening to another two people, no? So the question actually is a little bit of a this thing, that if the when there are two folios, so I'm digressing a little bit here. In a Companies Act, if there are two folios, and two folios will mean that transfer is happening from one folio to the other, then the nominee folio will also move to another folio. And when that folio is happening, a new shareholder is coming into the picture, then obviously you'll have to file two FCTRS.
Okay, sir. Okay. So the next question is, sir, what are the valuation requirements in case of transfer of foreign company shares from NR to R, from non-resident to resident?
So we discussed. So if you look at this transaction, transfer is from a non-resident to a resident for shares of a foreign company. So what is happening is you are making an overseas investment. When you're making an overseas investment, then either it's an ODI route or an LRS route. So the applicability will be based on the ability of the individual to make that transaction, and the valuation is very clear with respect to the fair value of those shares determined by a practicing professional. So it's again any internationally accepted pricing methodology determined by a practicing professional of that country.
Okay, sir. So the next question is, sir, in case of transfer of shares from resident to non-resident, do valuation has to mandatorily be done by a registered valuer?
So I think this is a question that we already answered in the presentation. It's a transfer of shares from resident to non-resident. And when a transfer is happening between R to NR, what is the status of that R will depend. Because if it's a company, then FEMA guidelines are to be followed. If it's an individual, then only FEMA have to be followed. But if it involves a tax implication on it, then you have to follow the taxation guidelines also. So it all depends what is the entity status of that resident who is conducting that transaction.
So it completely depend on the status of the entity. So the next question is, in many cases of valuation of transactions of unlisted companies, SEBI is also coming into picture.
Valuation of SEBI. I don't follow the question actually. maybe the gentleman or the person can have an independent discussion with me and we can have a chat about this, because SEBI is something which we're not taking care of here.
Okay. So the next question for today's is: can Indian private limited company can issue its unsubscribed equity shares to foreign company at discount if the Indian company sees in coming years, say 3 years, its net worth is going to be completely eroded? So if yes, at what conditions, looking into FEMA Companies Act, are DLOM and DLOC adjustments accepted by RBI under FEMA?
So let's get this fact right first. Acceptability of any valuation report is not dependent on what the RBI thinks. It's the valuer who has to create a valuation report at an internationally acceptable pricing methodology. And that pricing methodology has to be done in a manner that it stands the test of the regulator. But my counter question to this: does the Companies Act permit this? Does the Companies Act? I don't think Companies Act permit share of issue of at a discount. So I think whenever there is a transaction which is of this complex in nature, there will never be a clear answer to the question without full facts. You will have to consider the facts of the transaction. Also look at what the Companies Act and the income tax implications are, and then decide what is the best valuation methodology to be used. But yes, discounting for lack of control, discounting for lack of participation in dividend rights, all of those are standard discounting practices that are being used by valuers while conducting the valuation assignments and arriving at a fair value.
Get it, sir. So the next question is: could you please inform guidelines of convertible warrants by a NRI Indian listed unlisted company, whether a bearer convertible warrants issued by an unlisted entity can be tendered by NRI company, and whether it is FEMA compliant, or whether it is FEMA compliant, I think.
So I think this is a longer discussion to be made on this. Convertible bonds and convertible notes is a separate chapter altogether in terms of valuation. Yes, it's an important aspect which we are not delving onto this right now. But I'm happy to take this question and discuss with the gentleman the entire nuances of convertibles. So I would prefer to take this up offline with the person. You can share my details with him, and I'm happy to take it up with him. And this is a far larger discussion.
Okay, sir. So for the next question is: for APAR filling through AD, there is a new notification of RBI issued on 22nd October 2022 regarding compulsory audit of foreign entity. We have 100% subsidiary in USA. We have filed APR prior to the notification, but not submitted the APR form to RBI by AD Bank and asking for audited financial statement. The LLC has been closed. What to do now? Please guide.
So if the LLC has been closed, you should have filed for an ODI liquidation. And if the ODI liquidation has already happened, then why should this problem arise? That means the closure formalities have, are not being done properly. And I think it's important to write to RBI for a clarification on this at the FED help desk. They certainly respond back.
Okay, sir. So the next question is, sir, kindly advise the valuation of company shares under CIRP, transfer of shares to non-resident as part of resolution plan.
See, once again, these are questions which are asking me to conduct or advise on the valuation methodology. How one should value. how one should value is not the question here. I mean, how is a valuer perspective? And these are fact-based answers. There is no set rule in terms of how I will value a company, and will those rules be applicable to value the B company or a C company, whether in CIRP or under liquidation? What are the facts of those company? What are the value? See, I mean, if I look at it from a very broad perspective, if somebody is investing in a CIRP situation and taking over the assets of a business, there has to be some value. And any CRP dissolution will have to be done by an NCLT. So these are very, very fact-based questions. I cannot give a straight and a clear answer to them right now without having a look at the detailed facts around the discussion.
Valuation is not dependent on one factor or other factor. So there should be facts clear to answer this question. So the next question is for bonus OCRPS. What are the valuation requirements under FEMA and Companies Act? Is valuation report required both at the time of issuance and conversion?
Can you please repeat the question? I kind of didn't understand it clearly.
For bonus OCRPS, what are the valuation requirements under FEMA and Companies Act? Is valuation report required both at the time of issuance and conversion?
Bonus OCRPS, I really don't understand that term actually.
It has been written in short form, sir, for bonus OCRPS. Whether I think he is trying to put in question that valuation requirement under FEMA and Companies Act for bonus shares. I don't know.
Under Companies Act, obviously there is no bonus valuation required. That's very clear. We all know that. What does OCRPS mean? I don't understand.
If this participant is currently with us, so can you please elaborate the term OCRPS so that we can put this question again in front of sir. So by proceeding to further question, we can took it like this. Could you please inform FEMA guidelines for ESOPS by NRI employee to an Indian listed entity? And he has mentioned it in brackets. Board has approved ESOPS at pre-determined value as per price and as per SEBI guidelines.
So if the SEBI guidelines have already come into the picture, the pricing guidelines don't apply here. That's an umbrella. I think it's important for the gentleman to go and try and read, I think, Rule 8 of the NDI guidelines. And the Rule 8 talks about issuance of employee stock option and equity shares to a person resident outside India. And the valuation guidelines with respect to SEBI will obviously be overriding over the pricing guidelines given in the NDI rules.
That is, sir. Okay, so next question is for a newly incorporated private limited company whose net worth is negligible, how it can meet 400% criteria for ODI? And the net worth is based on last audited balance sheet and not necessarily the statutory audited balance sheet.
I think the understanding appears to be in line with our practice understanding also. We also follow a similar kind of practice understanding. It's absolutely right. The term used last audited balance sheet, and the term is not last statutory audited balance sheet. And in a newly incorporated entity, if you have a substantial net worth being created post incorporation but before the first financial year, you may get into a management or a special audit under the Schedule 3 reporting guidelines and may try and use that for your ODI.
So next question is, sir, A Limited India import goods from China and after clearing for home consumption and some processed goods export to B Limited in Dubai. During the year, A Limited India incorporate company in Dubai, in which both the directors of Indian company is directors in foreign company also. During the year, A Limited Dubai import goods from China and sold it to B Limited Dubai.
at cost price. What would be consequences in books of A Limited India for particular transaction?
Ma'am, I hope you understand this is a very specific factual question. I don't think it's fair on my part to conclude and advise on it right now, because without having a look at the detailed discussion and facts of the case, I don't think I'm capable to answer this question without the facts.
Okay, sir.
Sorry about that.
So the next question is, sir, in case of ODI, when you say date of valuation report not to be older than 90 days, do you agree that valuation date may precede 3 months or maybe a year or so?
Last part, do you agree?
Last part is, sir, do you agree that valuation date may precede 3 months or maybe a year or so?
Okay, so this is the practical challenges that we are also facing in terms of certain transactions, whether ODI or FDI. There are cases where you'll end up reporting late because of some reason or the other, and the valuation a date kind of predates the actual reporting transaction. But the AD bank is actually insisting on a 90-day-old valuation. So the RBI is yet to come out with a clarification on this, that, okay, what happens in case of late submission of these forms? But I think it's for you and the AD bank to take it together to the RBI if a case is genuinely of delayed reporting.
So the next question is, sir, what are the implications under Income Tax Act when issue price is more than the share price, FMB?
Income Tax Act is something which we are not discussing here. But then, yes, Section 56(27)(b) and the new rules, which are just under the public domain right now, will have implication with respect to any pricing issues that you have more than the FMB.
Next question is, sir, as you said that the valuation report is valid for 6 months. If the deal is finalized and the funds are received in India in tranches, will that be valid post 6 months as well?
I think it should be valid. I mean, I don't have a practical situation to address here, but this should be valid, I think, once the compliance and deadlines are made. But I think, once again, it's for the AD bank to accept in consultation with the RBI, because it appears to be a very specific transaction. And if there is a delayed submission, they'll have to give a reasonable reason as to why this delayed submission exists.
So the next question is, sir, please explain 90 days validity of valuation report. I think some of the questions are only related to the validity of valuation report.
I think because of this changes in the Income Tax Act, there's a lot of transaction planning that's happening. But then it's very clear in case of a transfer or a buyback, the validity is 90 days specifically. The provisions are very clear on this.
Okay, sir. Actually, we are left with so many questions, but by taking into considerations the shortage of time, I will ask the relevant only. Actually, all the questions are relevant, but I'll ask few of them, not all. So the last few of the last questions are: in case of unlisted shares transferred to NRR by R on non-repatriation basis, is it required to file FCTRS? What is the answer if it repatriation basis?
Okay, so I think the question has to be addressed. How was a transaction done initially by a non-resident? If a non-resident had done a transaction on a repatriation basis, then the entire investment should have been reported and got a kind of approval from the Reserve Bank of India, not the approval, but an acknowledgement from the Reserve Bank of India. But now, when the NR is transferring to a R, there is no reporting as such in terms of valuation. You have to follow the guidelines. But if it's moving to a R, what does it kind of entail in terms of non-repatriation? It's within the country, so it is the R to NR that entails this transaction, where you have an ODI coming in. I think the question has to be read differently rather than.
So the next question is: in case of swap of shares between foreign and Indian company, is there any threshold limit for valuation permitted by chartered accountant, etc.?
No, we discussed that earlier, no? That any ODI which is more than $5 million, you will have to go to a SBI category 1 merchant banker. So if the swap involves a valuation which is more than $5 million, you'll have to go to SBI category merchant, a semi-registered category 1 merchant banker. Anything below that can be handled by a chartered accountant. But in case of swap, I think chartered accountants are not even allowed to make a valuation. It's only the semi-registered or that country's registered investment banker that are supposed to make the valuation reports here.
Okay, sir. So we are trying to ask as many as questions, and sir has very patiently trying to answer all the questions. But as we have limitation of time, so we will hurriedly go through some questions. That is there a valuation requirement for right issue, and what is the validity for that?
Okay, so we'll have to obviously once again refer back to the NDI rules, which talks about the RBI, valuation requirements under rights. Validity, I've already said that 6 months, 90 days is very clear with respect to the validity of the valuation report. And rights issue will, as long as the rights are being offered to a non-resident at the same value as they are being offered to an existing shareholder or resident shareholder, the right issue will be a valid transaction to go through under the FEMA Act.
So most probably the last question for today's session is, what about issue of preference share of Indian company to a person resident outside India who is resident but ordinary resident and not non-resident?
I think I'll have to come. I mean, I don't have a set answer right now. Let's discuss this independently. Please share my details with the person. We'll have a discussion around this and give them a firm answer. I'll have to check and come back to you.
Okay. So as we are proceeding towards the winding up of the session, and sir has amazingly tried to answer all the questions, and I hope all the participants who have put their questions have got the answers. And lastly, I would like to thank you, CA Sachin Chugh sir, for enlightening us with the valuable session, and for sharing his knowledge and expertise with us today via this platform. And Valuation Manthan series has definitely make this platform available for all the participants. So thank you so much, sir, once again. And it was indeed a wonderful session, sir. It was indeed an amazing session. And last but not least, I would like to thank all the participants for their active participation. So many amazing questions you have all asked, and we have better tried to answer all the questions, as many as questions as we can take. So winding up. But before shutting down your system, kindly fill the feedback form that is popping on your laptop screen, and it would really help us to improve, and your suggestions are highly appreciated and it would be taken into consideration definitely. So thank you all for joining us today, and I wish you all an enlightening day ahead. Thank you so much. Thank you so much, CA Sachin Chugh sir.
Thank you, sir. Thank you, ma'am.
Thank you, Valuation Board team, to give me this opportunity to be part of this series once again. And I would like to thank you all. And by winding up this session with this note, thanks once again.